There are two ways that you can earn income as a dividend investor: stock appreciation and in dividends, which are a company's profits that are paid to investors. Now, of course, not all stocks pay dividends, but I'm a huge fan of the ones that actually do. But one very important thing to remember is that just because a company pays dividends right now doesn't necessarily mean that they're going to keep paying dividends going into the future. In today's video, I'm going to show you guys how you can use the dividend payout ratio to determine if a stock's dividend is sustainable going into the future. So before we get into the video, I just want to say really quickly, guys, if you guys are new to dividend investing, be sure to check out my Dividend Investing for Beginners playlist. I'll link to that in the description of this video. That will show you guys how to get started with dividend investing completely from scratch if you're brand new. And of course, if you guys are enjoying this video, please sure to give it a big thumbs up and subscribe to the channel if you guys want more dividend investing based Canadian content. Alright, now let's jump into the payout ratio and talk about what exactly the payout ratio is. So in a nutshell, the dividend payout ratio is basically a way for us to see how much a company's income is being distributed to shareholders in the form of a dividend. If a company has a lower payout ratio, this basically means that they are holding on to more of their profits for themselves, so ideally they can invest back into themselves and grow their company over time. While a high payout ratio basically means that a company is choosing to give out more of their money to investors, so there's going to be less money for themselves and more money going to investors who own shares of the stocks. And last but not least, it's important to note that a company that has a payout ratio over 100% is basically paying more money to their shareholders than what they actually earn in profit. And as you guys can imagine, paying out more money to your shareholders that is in excess of what your company's actual profits are on an annual basis is not a good thing going into the future. So how do we figure out a company's payout ratio? Well, there's basically two ways that you can do this. First of all, the easiest way to figure out a company's payout ratio is basically to use good old Google. So what you're going to want to do is head on over to google.com, type in your individual stock name, and then type out something like payout ratio at the end of your stock. Hit enter, and then Google will give you guys a bunch of results where you can easily see the payout ratio of your stock. Now, the easiest website I like to use to find this is marketbeat.com, and it's usually, generally speaking, one of the top websites here. So we can click on this, and this will give us a bunch of information about the stock that we want to look up at. Now, what you want to do is you want to look down at the bottom here, and you'll see here, I'll just zoom in here so you guys can see, is we have some basic dividend information here. We have the next dividend date, we have the annual dividend, the dividend yield, and then we have some payout ratios down here. So the nice thing about Market Beat is it will usually show us the trailing 12 months of earnings, which basically means that over the course of the last 12 months, this is the payout ratio of TD stock, which is 52%. And then we have another column right here at the bottom that says this is 52.88%, and this is based on this year's estimate. So this is estimating going into the future what they think that this payout ratio of TD is going to be, which is very useful. And then at the bottom here, we have a cash flow based payout ratio, which basically tells us how much money of TD's free cash flow is going into their dividend, and that's a very, very, very small 1% here. So as you guys can see here, TD stock has a great payout ratio. In hard times like we're experiencing right now, they've managed to maintain a 52% payout ratio, which is very, very good. And the estimate going into the future is going to be about 52%. And then their free cash flow is only 1%. So this is what makes TD stock such a good dividend stock going into the future. And TD, of course, is a good example of a dividend stock with a very nice payout ratio of 52%. That's pretty good. The other way to figure out a company's payout ratio is to do a calculation yourself, and although you don't need to memorize this or anything, it's always good to know just in case if you ever have to do it by hand. So a company's payout ratio is as follows: dividends per share, or DPS for short, divided by earnings per share, or EPS for short. So to give you guys an example, if we take a company that has an earnings per share of $4 and a dividends per share of $1.20 and divided those two, we would get a payout ratio of about 30%. So that is the calculation for the payout ratio. Now, generally speaking, you can probably just go on Google and search it up for each individual company if you like, but if you ever need to do the calculation, there it is for you. So let's spend a little bit more time talking about the payout ratio and how we can use the payout ratio to assess a stock and evaluate whether a stock is a good dividend investing stock to invest into. So as a dividend investor, there's always two things that you want to really look for when it comes to a dividend-based stock. Number one one is you want a company that continues to pay out dividends over time. And number two, you want a company that's going to steadily increase their dividend yield over time so that that money that you invest today will slowly grow and earn you more dividends, and you'll get that nice compounding interest working in your favor. And the nice thing about the payout ratio is we can use the payout ratio of a company to determine if a company has a sustainable dividend, and we can also use the payout ratio to determine if a company is likely to increase their dividends going into the future. So generally speaking, older companies that are more established will most likely have a higher dividend payout ratio, and the reason for this is because they can kind of afford to send out more money to their shareholders, and they have more leverage, and they have more they're more established, so they can kind of afford to do that, while a company that's kind of more newer or a new kid on the block might have a lower payout ratio so that they can invest more money into themselves and they can just kind of work on building their business overall. And the nice thing about a lower payout ratio overall is that if earnings of a company do get cut, or let's say a company has a really bad year, or let's say we have a stock market crash, at least there's some wiggle room for the dividend, so that if we see a massive drop in earnings, at least their payout ratio might not even be 100%. If a company has a payout ratio of about 30% and then we see some loss in profits, maybe their payout ratio goes up to 60%, but it's still under 100% and it's still not too bad. So it's always nice to go with companies that have a nice low payout ratio. And like I mentioned earlier, having a company that is able to sustain their dividend, especially in times of crises, is always a good thing and really the core of dividend investing. The last thing you want as a dividend investor is for a company to cut their dividend and you to lose a good chunk of that yield. And like I talked about earlier, it's always nice to see a company with a low payout ratio, because this means that they have more room going into the future to actually expand and grow their dividends, because as their earnings increase, they'll have that room to dish out more money to shareholders and increase their dividends over time. And of course, as a dividend investor, this is always a really good thing. And at the end of watching this video, if there's anything you guys get from this video, here's one thing to remember. If a company has a payout ratio of over 100%, you need to realize that this means a company is paying out more of its earnings than what it is actually making. And going into the long run, this is a very, very bad thing. And this really questions a company's ability to sustain their dividend going into the long haul. And for the vast majority of companies, this is going to be unsustainable, and this probably will lead to dividend cuts going into the future. If you're ever investing or looking at a stock to invest into and has a dividend payout ratio of over 100%, definitely proceed with caution and take a long look at the company's history and decide for yourself if it's worth the risk to invest into. And one important thing to note is that companies with the strongest dividend payouts and the strongest histories of dividend increases are all companies that have nice stable payout ratios. So if you're ever interested in buying a dividend-based stock, always take a look at the payout ratio, because it can really give you guys some information really quickly on how sustainable and how well a company is managing their dividend payments. Now, one thing I just want to mention really quickly here before I end this video is that the payout ratio, although it is a really good tool to measure how good a dividend-based stock is, it's not the only way of evaluating a stock. Always a good idea to look at the company's history, look at their past dividends or past dividend increases, and take a look at their finances, how much money they make, their earnings, and all this kind of stuff can help give you guys a good idea whether a company is worth investing into or not. But the two main things to remember is that if a company has a long history of growth, a long history of sustaining their dividend, and a very long history of increasing that dividend over time, those are the main things you want to look for. So I know this video is really short, but there's really not too much to talk about when it comes to a company's payout ratio. It basically just means how much money they're giving to their stakeholders, and although it's really simple, it's an important thing to look for, and it's an important metric to consider when you evaluate a stock. Now, before you guys leave, I just want to say really quickly that if you guys enjoyed this video, be sure to give it a big thumbs up and subscribe to the channel if you guys want more dividend-based content. Once again, I'll link to the Dividend Investing for Beginners playlist. Watch through that playlist if you guys are brand new to dividend investing, because it will help you out and help get you started. And last but not least, if you guys want to follow me along my dividend investing journey, be sure to check out my dividend investing case study. I'll link to that playlist as well in the description of this video. Thanks for watching, guys. I hope you guys enjoyed this video. Take care, and I'll see you guys later.